All right, in this video, I'm going to talk about some of the characteristics of disability insurance policies. One of the first things to evaluate for disability insurance policies would be the definition of disability. So to start with that, we could have partial disability or total disability. So a partial disability would mean that the insured individual is incapable of completing some portion of the assigned occupational tasks. Total disability would mean that they are incapable of performing their job duties entirely. Um, Now, there are also some occupational-based definitions of disability. So for those, there are a couple different types of policies. There are own occupation policies, any occupation policies, and hybrid definition policies. So let's take a look at those. An own occupation policy basically says that that if the person is unable to work in their own occupation, then they are considered to be disabled. Now, what that may mean is that for that kind of policy in place, they may limit the ability for the individual to work in another occupation. And that's where you get to the idea of a modified own occupation policy. But basically, the idea there would be if you are, say, a surgeon and you are in a car accident that makes it impossible for you to use your hands, and therefore you cannot be a surgeon anymore, then you are no longer able to participate in your own occupation. Or, maybe you have the use of your hands, but you have a tremor or something like that, so you can't be a surgeon anymore. So that's the idea behind an own occupation policy. And any occupation policy is going to be linked to what your qualifications are, but it's basically going to indicate that there's no job if that's available to you with your qualifications. So in the prior example of a surgeon in a car accident, now has a tremor in your hands, can't be a surgeon, well, but that person could probably transition to being a physician of some other form that doesn't require performing surgery. And so in that sense, basically, in any occupation policy would probably not qualify that individual as disabled because the individual could actually work in another area for which that person was qualified. And then there are hybrid definition policies. Hybrid definition policies sometimes are used by group policies, and those are, in some cases, own occupation for a period of time, followed by any occupation. So the idea there would be, if we follow along with the surgeon example, if you were a surgeon in a car accident, now have a tremor in your hands, the own occupation disability aspect would kick in, basically paying benefits for a period of time because the doctor could no longer perform the duties of the surgeon. But then after a period of time, it would switch to an any occupation approach, basically saying is if there is another occupation for which the person is qualified. So in other words, some other kind of physician perhaps that does not have to perform surgery, then in that case, it would pay less in benefits because there are other occupations available to that individual. Now, there are, in some cases, what's considered presumptive total disability for certain conditions. So, I think one of the ones that was listed typically is if you are suddenly completely blinded, then you're considered to be totally disabled. And then I think certain combinations of loss of limbs can lead to the presumption of total disability as well. Now, in some cases, if we're looking at certain types of policies, they may pay more for a total disability scenario, maybe not as much for a partial. So sometimes there can be a partial disability provision or rider, which basically says or creates a situation which for a period of time, the person will receive a lower payment. And the presumption there would be probably that if the person is partially disabled due to some kind of injury, perhaps, maybe as they're healing or recovering, they're partially disabled. And so it provides a lower payment. But the thought there, I think, would be that the person would likely recover. And so for additional cost, the person gets additional coverage for that limited window of time. There's also an interesting aspect that sometimes applies to certain disability insurance policies, and that is a residual benefit provision. And so in this case, this is a situation in which a person is eventually able to return to work, but with a loss of income. And if the loss of earnings exceeds typically like 20%, then there's essentially a significant loss compared to what was previously the case, maybe due to loss of time or duties. So maybe their progression is, or in the firm is delayed or damaged sort of permanently. Then basically that's kind of where this would kick in. And basically what this does is it's going to compare the pre-disability income with post-disability income. And if that loss is significant enough, then it pays a benefit. And this is often a permanent policy and would last for the extent of the policy or lifetime of the individual. Now, many disability insurance policies have an elimination period. And this is a situation in which the insured individual is disabled but not eligible for benefits yet. And so that brings us to actually kind of the benefit period and how that relates to the elimination period. So for benefit periods, typically there's short-term and long-term disability insurance. Short-term disability is typically has a short elimination period, so a brief window of time that the person has to be disabled before the payments begin. And generally coverage is going to be up to about 2 years or something less. Okay. The long-term disability typically has a much longer elimination period. So the person is going to have to be disabled for a much longer period of time before the long-term disability kicks in. But then coverage would typically last until either normal retirement age or the individual's death or some kind of time frame, some term. So the length of the elimination period between short-term and long-term is different. The length of the payouts is different as well. There are also some other provisions that disability income insurance typically also have, including the waiver of premium provision or rider. And the idea behind this is essentially that if a person becomes disabled, they no longer have to pay premiums, which kind of makes sense because if they are disabled, they aren't earning an income and therefore they don't have an income to pay the premiums. That's kind of the point of the disability insurance. There are some provisions as it relates to kind of recurrent disabilities and how that works out and how disabilities are sort of counted, whether they're considered to be sort of continuation of an ongoing disability or a separate disability, and then how that's going to relate to how some of those exclusion periods are going, or elimination periods are going to apply and so forth. There's some provisions pertaining to changes of occupation, cost of living adjustment riders sometimes can be included to perhaps boost the amount of payout to account for inflation, for instance, cost of living. Also, there can be some riders to the policy which account for future increases or automatic increases and things like that. Typically, a social insurance substitute rider, which basically links the disability payout to the social insurance payout. And this can be either sort of an all or nothing kind of a situation, or an offset. And so for the all or nothing situation, basically what happens in that case is a situation in which if you are expected to be eligible for the social insurance payout, then basically what happens is if you are not receiving it yet, then you get a payout. But when you get the social insurance, then it actually would switch over just to the social insurance. The offset approach basically assesses what the expected payout would be, and if from social insurance, and if the social insurance does not pay out that much, then essentially it would basically make up kind of the difference. So if your policy kind of assessed that they thought that you were going to get a $1,500 a month benefit, and then when time rolls around when social insurance kicks in and you only get $1,200 a month, then basically the $1,200 is now coming from social insurance, but the extra $300 is still going to come from the disability insurance. Incontestability provisions, assessing when and how it could be contested or not, and so forth. Renewability, can actually have like non-cancelable, often would apply until a certain age. So basically the insurance company can't cancel it. Guaranteed renewable would be a provision in which it can be guaranteed to be renewable for a period or perhaps until a certain age. Um, Often for disability, there are often exclusions that include things like war, occupational hazards covered by workers' compensation. Possibly pre-existing conditions might apply here as well. Sometimes probationary periods, basically so that somebody doesn't just buy a policy and then somehow contrive to make themselves disabled, which is a slightly appalling thought, but unfortunately, some people have thought about that. So there can be some exclusions that would affect policies as well. Okay, so hopefully this video kind of briefly overviewing some of the characteristics of disability insurance policies has been helpful. And thank you for watching and have a great day.